Hey there everybody, welcome to this video. I appreciate you giving it a click. If you don't know me, my name's Keaton and I'm here with another weekly review of what happened during this insane Q3 2022 earnings period. So the week before last, we saw airline revenues getting close to pre-pandemic levels with the increase in travel demand, but earnings still in quite a rough place. Bank revenues improving due to rising interest rates, but having compressed margins. We also saw a cannabis market, which looked quite incredible recently. But let's get into what happened this week. So we started off the week with Bank of America earnings. They reported revenue growth of 8%, yet had a net income decline of 8% from Q3 of 2021. Their margins were compressed quite a bit since this time last year. Year to date, their net interest income was up 19% from 2021 levels, and their non-interest income was down 8%. This means the revenue excluding the interest expense is actually up 5% from the trailing 9 months compared to last year, which is quite interesting and shows that even with the economic turmoil that's being caused by the rising interest rates, the revenue increase generated because of the rising interest rates is actually benefiting Bank of America quite a bit. But what was of interest to me was the insight they gave into the consumer spending during Q3. So they said a perspicacious analyst might assume that talks of inflation, recession, and other factors may justify lower consumer spending growth, but they just don't see it there at Bank of America. Their year-to-date spending is up 12% from last year, but they did note that it was slightly slowing this Q3 versus Q1 and Q2 of this year. If you're a perspicacious investor, you might want to pause on this picture because I found it incredibly insightful. So first off, it shows me that Bank of America customers have extremely high credit, so middle to higher class customers, which have been the individuals still being able to function in this current economic environment that's shifting so much. Consumer spending has been increasing, seen here with the credit card accounts and average outstanding balances increasing. But folks are becoming more and more hesitant to buy new homes or even get loans to buy new vehicles. We also heard last week from the JP Morgan's earnings call that consumer spending is still very strong while still having cash buffers remaining elevated across all income segments. However, they saw that spending has been growing faster than income levels, especially for the lower income segments, which with lower income families, this leads me to wonder how long these cash buffers will remain elevated as long as spending remains higher, since they will inevitably be the first ones and the hardest ones hit in an economic decline. I would assume with the painfully high inflation and the agonizing interest rates making purchases of anything substantial much more difficult, they are already beginning to get a hint of further pain to come in the future. Although Bank of America did hire 5,600 new employees, which compared to all the hiring freezes being put on by the tech giants, this is quite a sight for sore eyes. American Express gave quite similar insights this week as well, with overall spending being up 21% in Q3, with the travel demand dramatically exceeding their expectations. They noted that they had not yet seen a change in consumer spending, but are mindful of the mixed signals coming from the broader economy and are ready to pivot if the operating environment were to change rapidly. Goldman Sachs reported double beats with revenue and EPS coming in above Wall Street expectations, but note those expectations were literally on the floor. So they reported Q3 revenue that was down 12% year over year and EPS that was down 44% year over year, which since Goldman Sachs is arguably the greatest investment bank that exists, these numbers are quite abysmal at first glance. But when you look a little bit deeper, the fixed income traders generated revenue of $3.53 billion, 41% higher than Q3 of 2021, showing that market volatility has actually been helping them quite a bit with their own investments done by their traders. Netflix also reported double beats with net income blowing expectations out of the water, but still down 3% year over year. Their free cash flow is returning after the Next Game acquisition in Q2, but is still dramatically lower than in Q1 of this year due to the higher marketing spend and higher content acquisition spend. Now, Netflix did have some pretty big shows come out in Q3, which caused over 2.4 million new users to join. So it seems this excess marketing and content spend might have been worth it. Now, I think this is an impressive company, but this symbolizes the catch-22 with the stock. To increase interest, they must spend a large portion of their revenue But nevertheless, I'm excited to see what this company can achieve in the coming years. Now to talk about Tesla. So first off, I want to say I was extremely impressed with what they reported, but this company is absolutely priced to perfection. So if they report anything but the absolute best, there are always going to be shareholders who are willing to jump out. I say this because the stock price actually went down after shareholders heard the information I'm about to share with you. And that might be because people are extremely jumpy in this current market condition that we're in. But I tend to think that it's more so because Tesla has some investors who aren't very convicted and only read the headlines, not to mention the massive amount of traders that are in this stock. So let's get into it. So the price, I think, declined because of a 2% revenue miss from expectations, but this was actually a 56% increase in revenue for the quarter year over year. Operating income increased 84% year over year, allowing for operating margins to expand from 14.6 to 17.2%. Personally, this company never ceases to amaze me. They just become more and more efficient every time I look. Free cash flow increased 148% year over year, and their cash levels increased by 31% in the same time. I mean, guys, this is just beautiful. Whenever I bought into this stock, the general consensus was that they were going to fail and go out of business within 6 months. I mean, kind of just an incredible example on how, I guess the crowd was wrong with this one. So total production was up 54%. Total deliveries was up 42%. I mean, they delivered over double the amount of Model S and X's that they did in Q3 of last year. And this is all while increasing customer service with massive additions to their supercharger network and mobile service fleet. During the earnings call, they projected 50% plus growth year over year for the next few years. And Elon said he actually sees the energy storage sector of the company growing more like 150 to 200% per year. And honestly, there's so much more that I just didn't even mention. Then let's jump into the last company that I wanted to look into, which is Knight and Swift Transportation. So I thought they might give me a good idea of how the general economy is doing, since they basically transport a ton of goods to consumers buying all around the country. They ended up missing earnings expectations, but slightly beat on revenues. They had total revenue growth of 15% year over year, but their operating income fell around 2%, and net income fell around 5%. So their expenses increased primarily due to inflationary pressures, especially with fuel costs and driver pay, causing margins to fall. The CEO noted that muted trends in trucking have continued as supply chains seem to be catching up and adjusting for uncertainty in consumer demand. I noticed the truckload segment performance was falling compared to last year, and the less than full truckload segment was actually growing dramatically. This may be a bit of a jump, but it seems like companies with less supply are doing their best to service a large range of customers by shipping as much as they can, but being able to completely fill less trucks. During the earnings call, they also mentioned that smaller carriers are already experiencing much tougher times, which could have a restricting effect on the current supply. Now, they also said that all indicators are pointing to supply already contracting as we speak, and we didn't start off this contraction cycle with an oversupply. This to me brings the banking data I spoke of earlier full circle. So with demand holding strong and supply contracting, there's really no way forward without inflation rising if we stay in the same trajectory. Now, the Federal Reserve sees this, and that is why they've been raising rates so intensively, and that's why they've been focusing on raising the unemployment rate so heavily. And personally, even though it hurts me in my soul to say that unemployment should increase, honestly, with the amount of abundance and the amount of confidence that folks have out there with spending, not in the stock market because there's no confidence there, but the confidence people have with spending, if this continues, the inflation rate's just going to continue to increase in particular areas, and it's going to make it extremely hard for this inflation to disappear. And personally, I want this inflation issue to disappear as quickly as possible, but I'm faithful. I have full confidence that these issues will be worked out over the next 12 to 24 months, and they will be put behind us. And the companies that are going to perform the best are going to be the ones with the highest growth, that are performing the best on the bottom line, okay? So stay focused on what truly matters in this market I hope you have a fantastic rest of your day. And remember, always make your investing decisions for yourself. It's your money you're investing with.